Good day, fellow investors. The new JP Morgan Q2 2021 Guide to the Markets is out, and I have selected a few slides out of the 82 in the presentation to really discuss key important topics for current investing. Asset price, inflation in general. We have fiscal deficits getting larger and larger, which will lead to a supply and demand bond issue, more stimulus despite a good economy, and a strong emergence of the emerging market middle class. That's a boom that will impact your investing over the next decade. On the contrary, we have extremely low yields and high valuations. And given the deficits, given the money printing, the stimulus, we might see dollar or euro issues down the road. And all in all, the environment is one of very low returns ahead, but there is a solution. So the core factors to think about when it comes to investing over the next decade from a macro perspective are the factor that the fundamentals of Western currencies and Western economies are weak, that there is a powerful structural trend positive that's continuing in Asia, the emerging middle class, and that valuations, depending on where you look in the market, are high. So the key, if you want to invest well, is to position yourself so that you take advantage of these trends. That's the key. And if you take advantage, the difference is extreme for your portfolio and financial success. Now, when it comes to macroeconomics, I don't think we can predict what will happen in the next year, and you can see that's impossible to predict because stock market returns in the next 12 months can be down 40%, can be up 50%. That's something we can't predict, we can't estimate. That's where thinking about macroeconomics is a waste of time. But if we think about these long-term trends, let's say over 10 years, then we can push our investment returns a few percentage points per year higher, lower the risk, and that is what makes a huge difference when it comes to investing. And that's what I'm thinking when I discuss these factors. I'm thinking, okay, how will these factors impact the businesses that I own, because I want to increase my returns and lower the risk, because there is a huge difference that few think about because so many people are focused on the short term. If you think about long-term 10-year investing and invest, let's say today 100,000, if you get 15%, over 10 years you have 404,000, 10% 259,000, and 5% 162,000. These differences are crucial when it comes to long-term investing, and these factors that we'll discuss today are crucial in helping us increasing the yield here by just a few percentage points per year. That's successful investing. If you like this long-term 10-year approach to investing, crash that like button and consider subscribing if you haven't. Let's start. The first topic is asset price inflation. Low rates push asset prices higher, which leads to bubble creation. If we look at the S&P 500 from March 23, 2020, the index is up an extreme 92% over the last 14-15 months. That's an extreme performance, so it is almost as good as it has been during the 2000s bull market that lasted 7 years. So of course, this is because interest rates are low that push the value of financial assets higher and higher. When you compare zero interest rates that you get in your bank with the 1-2% dividend yield of the S&P 500 or a rental or something, everything is attractive. And that's why the ratio of US financial assets to GDP is now at extreme highs of 5.5 times, when just 25 years ago it was below 3 times. So low interest rates have really pushed this ratio higher, but the economy isn't doing as well. Actually, economic growth is going down and has been going down compared to the previous periods significantly. So there is a demographic issue in developed countries, and we will see how will this end up. The key is that yields are low, bank yields. If you invest 100,000 in a bank now, you maybe get $80 per year, while in 2006 you would have gotten 4,510. Of course, the Fed has pushed rates to zero, and real rates are actually negative because of the monetary environment. And actually, economic fundamentals are bad. Economic growth, as we have seen, is slow, but the only solution that the Fed and politicians come up to is more money printing, which leads to more monetary inflation, as we have seen with asset price inflation. And that is an issue because this party will have to stop someday. Nobody knows when, but will have to stop one day. And that is key for balancing the risk and reward of your long-term investing portfolio. If we look at the federal budget of the United States, this is insane. They are borrowing 44% of spending. So for 2021, 44% of spending will be borrowed. And yeah, you can say, okay, these are extreme circumstances, but then you look at the forecast for the Central Budget Office, and the forecast is that these deficits will simply continue over the next decade at an incredible rate. And these forecasts are made based on low unemployment, no more recessions over the next decade, low inflation, and low yields practically forever. If something changes in this forecast, all these projections are toasted. Let me show you one thing about projections. This is inflation expectations over the next 10 years. The expectations were 2.5% for the last few years, and now, just over the last 6 months, the expectation is already at 3%. And who says that this can change to 3.5, 4%? If that happens, and interest rates change, then all the projections and all the calculations also change. And this might also have an impact on the dollar. The US trade balance alongside the deficits is negative and will likely continue to be negative, which will have a big impact down the road on economics, refinancing, borrowing, because everything looks great now due to the Fed just printing and protecting everyone, because people still have faith in the US dollar, the euro, and all those currencies. But what's the logic of investing in the US 10-year Treasury when your real return is minus 2.35% per year? That's insanity. So you have your money and you want to buy US government bonds, and you know that you will lose 2% per year. Who in a sane mind would do that? Nobody. That's why the Fed is buying 120 billion of bonds per month, and if they stop buying, there is nobody that wants to buy US government bonds on these yields. And if they stop, which they can't, then interest rates must go up to service this bond demand and supply imbalance. And the government, with such huge debt ratios, cannot tolerate higher interest rates. So if interest rates go up, the government has to pay more and more interest, which is insane, and on the already high interest payments. So that would create a spiral of very, very negative issues. So what is the solution to keep things as those are? Simply print money, print money, print money, which leads to asset bubbles and monetary inflation bubbles in developed markets. And this leads to high valuations, but there is a solution if you think about and invest for the long term. If we look at the S&P 500 valuation measures, those are on par with dot-com bubble measures, and it's logical that when valuations are high, returns are low. It's expected that long-term, especially real returns, will be very, very bad. Even if all things happen well and interest rates stay low forever, the dividend yield of the S&P 500 is below 2%. That's your return. With 2% economic growth, that's 3, 4, 5% from investing in this environment. And that's about it. If you want more, you have to do things differently. And then, again, 4% with huge risk, with dollar risk, with economy risk, with deficit risks. Why don't I go for 10% with much lower risk? That is what amazing, great investing is. And if we look at valuations, comparing the valuations globally, you see that there are always these periods of trends and sentiment. Now the market is crazy about the US market, money is still flowing there, great businesses of course, but valuations are getting crazy. Emerging markets, people are not having a positive sentiment towards emerging markets, which creates an imbalance that we might want to think about when it comes to investing in businesses. If we just look at what's the reality there, the emerging market middle class will boom. Over the next 10 years in Asia Pacific, 1.5 billion people will enter the middle class. And this has a huge investing impact. Demand for commodities will go up, competing to the rest of the world, thus prices might go up. This means more inflation, no matter how you put. We are 800 million in Europe, 300 something in the US, and are 1.5 billion people competing for the same resources on the planet. Who are we kidding here? So that's something to think about. Demand for real financing, options for financing and returns there are getting better and better, so you have to compete with the rest of the world when it comes to issuing bonds, and investment returns there are better. Just look at what's going on, the growth of the Chinese consumer, add to that the growth of the Asian consumer down the road next decade, and that's a strong trend to be exposed to. But if we look at the corporate defined benefit pension plans, endowments, 49% there is invested in fixed income, developed market fixed income. So that's an assurance that those pension plans will not be reached. Also, pension return assumptions are still very, very high, 6%. State and local governments are lowering, but still to above 7%. In this market, this is insane, and they will reach maybe 4, maybe 3%, which means that compared to inflation, they are not reaching real positive returns, which is destroying our long-term pensions. So that will be another issue with huge deficits. I think JP Morgan estimates a 2 trillion pension deficit coming ahead. That's something really to think about. Will be monetized, but the Fed will save you no matter what, but the value of the dollar has its limits with so much printing. So when it comes to that, when I look at businesses to invest in, I look at, okay, how it is exposed to those long-term trends. Is it up, low risk, or high risk? If it's high risk, I prefer to look at businesses that have these strong structural tailwinds. Warren Buffett says that his biggest lottery was that he was born in the US at a great moment in time, and he has enjoyed this US of A investing tailwind for the last 70 years. But now, developed markets, we in Europe, we are competing with Asia where the tailwinds are, so we might think about structuring our portfolios and looking at investment opportunities. And this is what can happen. I cannot tell you when it will happen. I know that things will remain stable, and then at one point crash hard. That's usually how things evolve. We have seen 2008, so stable, and then crash. So it will be the same now, because when the sentiment switches, things will get ugly for the risky, let's say, financial structures out there. And that's something you have to avoid from your portfolio. And then if you are avoiding those, whatever happens, then you know you are Okay, so I'm avoiding investments related to US dollar, too much exposure. That's also something that I'm thinking, okay, if the business does well, okay, but the dollar might also lose value long term. So I'm positioning myself, or when I analyze businesses, I look at these things. And if you want to check one idea, check my latest Alibaba video, negative sentiment, low valuations, huge structural tailwind. For deeper analysis, check my stock market research platform. Smash that like button, crash that like button, and I'll see you in the next video.